a spring-like day here in New York City. By the middle of next week, we'll be in the 60s. Nice and warm. But for the market, it still seems like we are in the heart of winter, and tech is frozen. Over 40% of the Nasdaq stocks are down at least 50% from their highs. Check out these massive drops from the likes of DocuSign, Zoom, Meta, even Netflix. The Titans also tumbling. Amazon down 22% from its peak. Microsoft up 19%. Apple falling over 15%. So is a spring thaw ahead, or sticking with the frozen reference? Do investors just need to let it go and give up some of these beaten down names? Dan, I'll go to you first. I mean, it's one thing if a pocket of the market, which were initially the high growth, high valuation innovation names, were getting beat up. But when it's getting to mega cap tech, that's a different story.
Yeah, I think, Mel, it's really hard for a lot of investors who really believe in some of these secular stories, some of these managements, some of the companies, the products, the services, and the trajectory that these technologies are on. So when you see, the disconnect between the price action and what you think the forward fundamentals are, it's really hard, right? And you just gave us the stats about what the Nasdaq looks like under the hood, and it's not pretty. And we've been saying this for a while. For all intents and purposes, large parts of the stock market have crashed. So now what I think investors have to do, if they're thinking about letting go of some of these big losers, is think about where we are. Are we going to have the sort of V reversal that we had in Q1 into Q2 of 2020? And I think not, largely because at the time the Fed was throwing, hundreds of billions of dollars of monetary stimulus that was going to be followed by hundreds of billions of dollars that ended up being trillions of dollars of fiscal stimulus. What's going on now is the Fed is actually tightening policy. And so these valuations don't look good. And then we have, as Mike Wilson said on the show last night, we have this kind of, demand kind of snapback, if you will, from the pandemic. So I just think it's a really bad setup to try to pick bottoms. But I'll make one point. From the highs in 2000 in the Nasdaq to the lows in late 2002, we know what happened. We saw, 70, 80% drawdown in the index. Many of the stocks were down as much. But as Jim Cramer likes to say, there's a bull market everywhere. There were three 40% plus rallies during that period. So there will be bull markets. And if you're nimble, you can catch them. Right now seems like a really bad time to try to do that. But we are on the precipice probably of a very sharp rally very soon.
At least two of you today, maybe three of you guys, were tweeting about Apple's 200-day moving average. The notion being that once it breaks that, it could be trouble below, Tim. Are we just holding our breath, waiting to see if Apple hangs in there at this point?
Well, I mean, and Apple may be Olaf in the frozen story here, because, I mean, he's been the one happy player in all this. And it's a case where if you look at Apple where he closed today, I think, a buck over the 200-day. Apple hasn't spent a lot of time below the 200-day in a couple of years. And so if you think about, we've been saying this, the weakening of Apple, the weakening of 4 or 5 stocks actually would be consistent then with a follow through from higher quality stuff, which is on some level, it's almost like let's get on with it, because I think we have had a crash. There's no question about it. We're going to talk about the K-Web. That's down 70%, 5 of the biggest tech companies in the world. But all the names that we talked about that are .com stocks, that are COVID stocks, but even some much more important stocks. We've talked about this with Netflix. So, if you look at the triple Qs, they have underperformed the S&P by about 8.5% since January 3rd. If you look at the triple Qs, they've been below the 200-day for the longest period that they have outside of the COVID dislocation in the lows of March since 2016. Again, so we've been in a tech bull market for a long time with a hiccup around COVID. This should be concerning for people, because I think this is at least a gut check.
Well, whenever you have a sell-off of the market, they always take the largest cap, safest stocks last. Apple, Google, Amazon, Microsoft. They took them last. But they didn't knock them off, right? So what they did knock off is all the ones that we introduced here, the Zooms, the DocuSigns, the Pelotons. Those are probably never coming back. So other than a gamble, come back. So when I look at it, Facebook, does Facebook even know who they are anymore? I don't think so.
Wow,
it's rhetorical.
I don't think question.
So. It really
it's a very deep question for Friday.
I don't think Facebook knows who they are. Metaverse doesn't know who it is anymore. So how do investors know about whether they should put new money to work? So I think that one is on the precipice of falling out of bed. If I had to put new money to work, it would be Apple, it would be Microsoft, but it wouldn't be Meta.
Jeff, you were also tweeting about the 200-day moving average in Apple. Is the notion that we have to see that flush in the mega cap tech stocks as well? And how hard of a flush would you say we have to see? I would imagine it's not as big as let's say ARC Innovation, which was up, I don't know, it was 70% lower from its highs in February of last year.
Yeah, I think there's going to be a difference ultimately between the quality growth stocks and the junk, I'll call it. And I think you are going to see a snapback in growth as we move into the second half of the year. I've been talking about that kind of over and over again, but I think we're seeing this opportunity unfold. I think you want to set your sights, but I don't think you want to pull the trigger. And I think a big part of that is because eventually you are going to see Apple crack. You are going to see Tesla crack, both kind of flirting with the 200-day moving average. To what extent they end up moving to the downside, it's so hard to know. But I did find it interesting. Our friend Chris Ferrone puts out a market low checklist. So put Apple on that market low checklist. Hasn't broken yet. So that hasn't checked off the list. We haven't had a put call ratio in the 99th percentile. We haven't seen spot VIX over 40. You kind of go down the list, and there are all of these things that you might expect to happen in a true correction, in a true bottom, and we haven't seen that yet. The last thing I'll say is, we're talking about all these COVID stocks, DocuSign being one of them, but it's a perfect example, right? This is a stock that was trading at 200 times last year, but it's got negative return on invested capital, so kind of a nerdy way of saying it's not profitable. Those are the stocks that aren't going to snap back, in my opinion. It's going to be the Googles, NVIDIAs, Microsofts, but then growth stocks outside of tech, too. Sort of random names like Public Storage, O'Reilly Automotive. These are stocks that have actually held up pretty well so far, and I think investors are going to move toward them as earnings revisions start to slow down and people really look for companies that are able to grow earnings. That's where you're going to find it.